Happy Tuesday, my dear ladies and gentlemen, and a warm welcome to our today's webinar on, usually in the autumn, our ESG template. My name is Michael Bommer, and I'm glad to have excellent guests which will guide you through today's webinars, being it regulatory matters, being it the template itself, being guidances, experiences, needs, requirements from the LP perspective. So it's the fourth time we talk about this ESG template, what we called for 3 years now, as some kind of amendment and addendum to the EET, the European ESG template. So what especially, we have some requirements from the taxonomy, Article 8 Delegated Act, and the CSRD, ESRS reporting for private markets, alternative investments, illiquid asset classes, what is not covered within the EET. That's why we had followed by requests on from the insurance industry and the LP perspective, worked on this template, updated every year, and renewed it this year due to quite significant regulatory changes Yegor Tokarevich will present us later on. So I'm happy that we have our capacities within BAI with lots of people working on topics like these ESG templates within our association, derived from our working group on ESG and sustainable finance. So we have this ESG template. We have lots of other guidances, practices, papers, position papers, and so on. We develop and elaborate together with our member companies, and to underline also with many investors, for instance, for this ESG template, like our two guests from the LP side, Amalasvinta-Lee, Dr. Amalasvinta-Lee, and Marius Hutmacher today. They will share with us their investors' perspective. And before, Yegor will guide us a little bit through the regulatory requirements we have all seen during the omnibuses passed through Europe, and the significant changes in the taxonomy and CSRD regulations. Joseph will then shortly shed the light on the template itself. And I'm quite happy that you have a good program today with all this perspective from a regulatory side, from an investor side, and also from the how we do it perspective. So I just want to briefly show you what you might expect next from our side. We have some greater and some smaller events also in this autumn. So just today we start after the summer break with this webinar. In 2 weeks, today in 2 weeks, we have our first insight after the summer break together with PwC on smaller registers, AMs in Frankfurt, followed by the Innovations Day, followed by the Real Assets and Wealth Management, and also, sure, followed by our traditional workshop on sustainable finance and ESG, where we might also meet again and live in practice some of today's active. If ever you are interested in what we do and publish, you might find everything on our website for free. So just an idea what you get on our website. Well, having said that, I just like to welcome again all our active parts today. So starting with Yegor in the order how they will speak. With Yegor, he's the CEO and founder of Substance Over Form, and for a short a period also a co-CEO at Risk Consult Group, so they some kind of merge together. And he's one of the best examples within our association how we work together with the practitioners. So active in lots of subgroups we have, not only in the EET group, developed also our BAI best practices at the beginning of the SFTR reporting seasons. He's actively when we write our consultation responses to ESMA, to the Commission, and so on. He's accompanied today also by Joseph Allen, so a colleague and associate product manager at Substance Over Form, who does also what everyone has to do, beginning with the observation of the regulatory requirements and translating them into what we call templates or best practices and so on. And we have very happy to have these two guests with us, Dr. Amalasminta Lee from Barmenia Gotha, from ALH Gruppe, so one of the large German insurance companies. And she does exactly what we do as a whole in this webinar, so translating the ESG regulation into data and reporting processes. Same for Marius Hutmacher. He is from Barmenia Gotha Asset Management and does the same in his insurance company. So also at the both sides, regulation and templates, playing with ESG data, I might say. And I'm really happy that you have both these experts with us who have helped us develop this ESG template in its third version and to design it to the needs from the practice. So with that, I give over to Yegor. I'm really happy that we have you all here, and I wish you insightful webinar minutes till midday.
Michael, thank you very much for the warm welcome and also the great organization of this webinar. I must say this is already our traditional webinar because we're doing it for the 4th year. And why are we doing this for the 4th consecutive year? Well, because every year there has been some kind of a regulatory change. 4 years ago, we only had Article 8 taxonomy DA, if you remember. So the insurance companies reached out to us and said, we need some kind of a standard to get the data. So the first version was actually not called BAI ESG template. It was called Article 8 taxonomy DA template. The year after, we had CSRD and ESRS, which then required also provision of GHG emissions and PCAF scores and some other data. So we had to change the template again and add additional data points. After those 2 years, the 3rd year was actually in the spirit of simplification, whereby we had to think about simplifying the existing template based on new suggestions of in the EU simplification package. And now it's the 4th year where we have actually a massive change driven by the simplification initiative, which in turn changed the template one more time. So we thought it's actually a good idea to have this conversation again. What happens next year? There's the question for our LP panel at the end. And this is why I'm very happy also to have the reason why we're actually doing those webinars here, which are our dear LPs. And with Amalasminta and Marius, we have 2 amazing experts who do this on a regular basis and have very deep knowledge in terms of products, but also in terms of the regulations. So we'll certainly learn a lot from them. So let's kick it off with the actual regulatory requirements. Let me just try to do the laser pointer here. Perfect. Okay, so let's start with the same slide we already had last year. If you look at it, we have now in the 4th year, more or less an established template framework for regulated EU LPs. EU LPs are usually, especially large EU LPs, are usually regulated by 2 main frameworks, one being the CSRD with additional frameworks linked to it, which is ESRS and Article 8 taxonomy DA. So this is what we're going to talk about today. That's the topic of today's webinar. Based on the Article 8 taxonomy DA, it's taxonomy KPIs that have to be reported in a certain format. And based on ESRS, those are financed CO2 emissions. They have to be reported in a certain format. So all this is basically part of the BAI ESG template. When does the BAI ESG template required by LPs? Well, depends on the LPs, and we'll ask them later, actually, what their exact requirements are. But we would say from our experience that depending on the process of the LP, they would usually request it from October this year, for this year, even if it's not finished yet, to somewhere mid-February 27 for the financial reporting year 26. Why is it the case? Well, because they need to finalize their annual statement at some point as well and publish everything. So the process is rather challenging, I would say, in terms of the timeline. Sometimes it is fairly difficult for GPs to provide data, especially here you see for 26, and if you need to provide 26 data by October 26. So it's a bit difficult probably for the GP to provide it on time. So it is usually possible, as long as the LP agrees, to provide the latest available one. So as long as you meet the timeline, usually it's actually almost more important than providing the correct data too late, because then the LP has nothing. But again, this is something we'll certainly hear from Amalswinde and Marius later, how they view this. And then we have obviously another framework here, which is essentially SFDR. And under SFDR, there are many requirements, but for regulated EU LPs, the key requirement is currently the PAI reporting, so reporting of principal adverse impact KPIs. And those are usually reported right now via the EET, the European ESG template. It's now the, I believe, 5th year where this will happen now. And this usually is required a bit later than the BAI due to a different process, since it goes into the PAI statement and not into the financial statement. Usually the ET is required between March and June of 1 year, depending on the LP, and the same principles in terms of data timeliness, data quality, and data, let's say, speed applies here in the same way as for BAI. So while both templates have a certain overlap, as it may seem, in terms of some data such as GHG emissions or taxonomy data, it is important to mention that the templates still are different, and one template will not resolve the question or the problem of the other template. This is because, unfortunately, the requirements for the calculations, the requirements for what is eligible, what is not eligible, how to calculate certain things. Do you calculate them based on one annual statement or based on 4 quarterly observations? How do you work with derivatives? Is it on a net or a gross basis, and so on? Unfortunately, they're different between the regulations. So therefore, whatever you provide, let's say if you provide GHG emissions, the BAI ESG template, they might not fulfill the requirements of the SFDR where you need the EET. So therefore, even if some content seems to be similar between the templates, the requirements usually are different governing them, and so are the timelines. So that, I think, is an important point to make. So it's not either or, usually it's an and requirement. With that in mind, I'll now move on to the biggest change that happened or is about to happen this year, which is the Article 8 taxonomy DA. Important point to mention, as always, Article 8 taxonomy DA has nothing to do with Article 8 SFDR. So if you know Article 8 from SFDR, forget about it for this webinar. This has nothing to do with this. It's a bit confusing because it has the same naming, but essentially Article 8 taxonomy DA is a reporting requirement for taxonomy KPIs for CSRD investors, which has a completely different, let's say, motivation and legal framework as Article 8 SFDR, which is a product disclosure regime based on a completely different set of requirements. So Article 8 taxonomy DA. What is the situation here? And this is, again, a slide I could recycle from the last year's webinar. However, I updated it. So last year, there was a change where insurance companies were actually able to make a decision to either opt out of taxonomy reporting for 2 years, so year 25, 26, or they could already start using the new template last year. Usually, this hasn't happened, excuse me, because it was a bit of too fast for them to change all the systems. Or they could have used the old template last year and start using the new template from this year onwards. And that is exactly what we are talking about, because the majority of investors decided to go for the option 2, since, like I said, it was too fast to change the template and they needed more time to prepare. The opt-out version didn't work for many investors because those investors who wanted to disclose some taxonomy ratios under SFDR usually didn't want to opt out from taxonomy disclosures under CSRD. So therefore, they kind of made the decision to continue disclosing taxonomy metrics. And yeah, the new template from the last year onwards wasn't used by many participants due to the time constraints. So therefore, what we are talking about is actually about the option of last year was still the old version, but this year investors start using the new version. So if we now move on to this new version, as you can see, we now have actually only two options for investors. Either they're still in the last opt-out year, and next year they'll use the new version, or they're already, so they haven't opted out and they will still use the new version. So let's talk about those who will use the new version and require it from GPs this year. So now you can see a couple of screenshots, and those screenshots essentially are coming from the new Annex 10, which is the key requirement that insurance companies will have to disclose on their websites. So as part of their 26th annual statement, they will have to disclose this on their website next year. So somewhere in Q1, I believe, next year. So in order to disclose this, they'll need data, obviously, from GPs. And this is what the BAI ESG template is designed for. If we look at this, the structure follows a completely new framework as opposed to the last year. And I guess the key point here is, as you can see, it starts with total AUM, which essentially more or less for an alternative investment fund is basically the total assets or balance sheet usually of the fund. However, we now have a new definition of covered assets. And I'll show it in an example on the next slide, but this is the most important change. So basically the covered assets now are narrowed down to a very limited amount of basically covered / eligible categories. And those eligible categories of covered assets are defined here. So essentially those are CSRD companies that publish taxonomy statements. Those are other counterparties, including real estate. So this is where real estate, real assets would go into. And those are voluntary. So there are a couple of other categories, but for us, another important one is this one, which means exposures included on a voluntary basis. And those voluntary basis exposures are typically so-called use of proceeds exposures. And use of proceeds is the category that will typically be applied to infrastructure projects. So where you have an infrastructure project, which is real asset, financed by an SPV usually, you would know what this asset, what the investment is used for. So it's basically part of the use of proceeds requirement, in which case it would be possible to also disclose taxonomy ratios for infrastructure assets. There are a couple of other categories falling under this, but I would say the main three for the real assets and private market corporate structure, so private equity, private debt, are those three. So CSRD companies, real estate, and use of proceeds via the voluntary basis. So this is where private markets would expect to report the majority of covered assets. So now, once we have those covered assets can now be broken down for eligibility and alignment, which is basically those tables here. And as you can see in the eligibility, we have now nuclear and fossil gas as well. This is the Annex 12. So before we had a gigantic, I think 2 or 3 pages long annex for nuclear and gas. Now it was simplified, which is great, and is now basically reflected in the Annex 10 as this small breakdown here. And then there is a whole bunch of all kinds of alignment breakdowns here, which is a bit similar to what we had before. So the good news about this is it definitely looks much smoother than before and probably more intuitive. The bad news about this is whatever you report here will be not comparable to the last year because the methodology is completely different. Also, the checks and validations that will be used here are very different to the last year one. So basically, every insurance company, every GP will now have to rethink everything from zero and think, how can I apply this methodology, the process, to this new framework? So now let's have a look at the methodology a little bit. And in the methodology, there is as you may know or remember, there is a definition of a KPI. So KPI essentially is an indicator, right? Key performance indicator. And what are taxonomy KPIs? Well, taxonomy KPIs are usually taxonomy eligibility KPIs or taxonomy alignment KPIs. And if you wanted to calculate a taxonomy KPI, you usually have a numerator and you have a denominator. So you divide one number by another one, simply speaking. So in the numerator, we still have taxonomy eligibility and alignment in euros, which is the same as last year. But the big change is in the denominator. So the denominator is now much smaller because now in the denominator, we only have covered assets. And this is a big change because in the past, we would have the total balance sheet more or less, excluding certain items, but more or less the total balance sheet of a private markets fund as a denominator. So this would lead to very, very low eligibility and coverage ratios in many cases. No? So you would sometimes have an eligibility ratio, coverage ratio of maybe 0.1% or 2% or something, right? In the past, because the denominator was large and numerator was slow. However, now the denominator reduced dramatically because now it only includes basically items that can be taxonomy eligible or taxonomy eligible or and or aligned. So what are those categories and what is different to what we had before? So we now have CSRD companies, same procedure as last time. We can also include non-CSRD companies. However, we don't expect those companies to be included too much because only those non-CSRD companies are allowed to be included that publish an official Article 8 Taxonomy DA statement on the website. So it's not something what you can do as a GP that you get some data or something. So this is really where you have the official taxonomy annexes published on their website on a voluntary basis. And well, I don't know what your view is, but I haven't seen too many of them in, let's say, private equity, private debt portfolios, right? So probably this category might be rather irrelevant. Then we have real estate as a specific category. So it was the same as last year. We have now infrastructure, which can be included into use of proceeds on a voluntary basis. And we have other like retail, local governments, but those are usually items that are not very relevant for private market funds. So again, CSRD, real estate, infrastructure are the most relevant categories. What is important is that the non-CSRD companies were removed from the denominator. So specifically for private equity, private debt, strategies, it means the denominator will be much smaller. Derivatives and bank deposits are also removed now. It means for any fund with those items, which is usually almost any fund, because any fund will have bank deposits, will have some cash, will have a smaller denominator. So that's really a big change. And I'll show an example in a second what exactly it may mean as a consequence. So now if we compare last year to this year, we'll see that for private equity, private debt portfolio companies, we still have the same categories with CSRD, non-CSRD. For real estate that used to be in other counterparty usually, we now have a specific subgroup called other counterparty real estate. So we have a specific subcategory. It's still under other counterparty, but it has a specific category as created for real estate assets. For infra projects, we have a change because infra projects used to be in other counterparties where they were not part of CSRD, and now they can go into the category of voluntary known use of proceeds. So this is usually where you would now basically have to change the allocation to a new category. And bank deposits and derivatives, which used to be allocated to some categories, they're not anywhere anymore. So they're not allocated to anything anymore. They're completely removed from the covered assets. So we already have a bit of a change of classifications of balance sheet items. And these classifications don't just lead to, let's say, reporting classifications, it also lead to the change in the outcomes. So for instance, if you look at the balance sheet of a hypothetical fund, it will have, let's say, 5 euros in CSRD companies, 70 in non-CSRD, 10 in real estate, and 15 in bank deposits. So the total balance sheet will be 100. So now, if we look at this, the only ones that are covered assets are real estate and CSRD, because non-CSRD is not eligible and bank deposits are not eligible. So if we look at the old methodology, we would have total assets of 100, and we would have 100 covered assets. So our coverage ratio would be 100, because basically all assets you see on the balance sheet are covered and have to report. And then this would result into very low eligibility alignment ratios, because we would always divide everything by covered assets of 100, so by the entire balance sheet. So let's have an example here with taxonomy alignment. We only had we only have €2 of taxonomy alignment, one for real estate and one for CSRD. So now those €2 we would divide by 100. So we would have on the taxonomy alignment of 2%, so 2% of total assets. However, now in the methodology 2026, we have covered assets which are significantly smaller than what we had before, because now they are 15 instead of 100. So only those that really fulfill the definition of covered assets. So therefore, the covered assets will be 15% instead of 100. And all ratios will be divided by 15 instead of 100. So this will lead to significantly higher outcomes. So you see that for the same balance sheet, we will now have not 2% taxonomy alignment, but 13. Instead of 12% of eligibility, we'll have 80, because we just changed the methodology. And I think this is actually the key change of methodology, that if this year, all of a sudden, you have amazing taxonomy eligibility and alignment numbers, in many cases it will not be because all of a sudden everything is taxonomy aligned or eligible, but just because the denominator changed. So it still probably report the same, more or less, but in a different way. And therefore, whatever we have this year is not really comparable to the last year's reporting, since it's calculated under two completely different methodologies. And that's probably also a little bit of a criticism on simplification, because simplification always means something is easier, but then also you have to basically rethink everything and start from zero, because this obviously is a big change of existing frameworks. So that is, if you forget everything this webinar, don't forget this slide. I guess this is the core of the change in the methodology. So what else has been happening in CSRD ESRS space? So now I move from Article 8 taxonomy to CSRD ESRS. I'll not go through everything here. We had some changes which are the same in CSRD area, including stop the clock and omnibus. In Germany, funnily enough, we still do not have the CSRD implemented. We still have the CSRD Umsetzungsgesetz being discussed. Maybe this year it will be implemented. So this has been following us basically for the last years, really, without any significant change. So also interesting how it works in practice. On the ESRS side, there has been actually a major change, because there has been an ESRS simplification, which will reduce a lot of data points significantly. However, the data points which are relevant for our purpose here in our reporting for LPs will remain the same. So GHG emissions and PCAF scores haven't been touched. Because they're basically the core of the CO2 emissions reporting. So here, even if there are some changes on the ESRS level for insurance companies, for the reporting from the GP to the LP, no changes are expected in this area. And then, of course, we have the SFDR. Since it's not the main part here, I will not lose too many words on this, specifically because BAI is following SFDR very closely, so I'm sure there will be also more information material, webinars, or opinions and events on this for sure, including our BAI workshop at the end of the year. But maybe briefly what's happening here, so that we have a bit of an outlook holistically. So we already have the first draft of the SFDR 2.0, which has been heavily discussed on all EU levels, and will be quite dramatic and revolutionary rather than evolutionary, and change everything, especially because labels will change. PAI statement might fall away on the company on the entity level, but then PAI might become mandatory to some extent on the product level. Instead of product disclosures, there will be product labels, which the industry have been hoping for a long time. And there is going to be a higher requirement framework for data governance. So basically, where the data comes from, how do you validate correctness, how do you make sure it's consistent, and so on. So quite a few changes in the first draft. And of course, the most interesting part will be also for us later. What does it mean concretely? Which templates will be needed? Which reporting formats will be needed? How is data interpreted, and so on. This is usually in the RTS 2.0, the regulatory technical standards. However, there hasn't been a version of this of a first draft yet. Hopefully it comes, I believe next year was more or less the expected timeline, but let's see. In any case, there is still a lot of work to be done. So what does it mean for us now? I think observing and seeing what's going to happen, especially how will it maybe be aligned to the CSRD framework that we discussed before. We put here 2029 as an expected application date, so still a couple of years. And of course, if this changes, ET might and probably will change as well. But this is, let's say, not in the very near future as it seems. And with that in mind, I'll stop now and move on after this quick regulatory update to Amala Swinta, who will tell us something about what the LP insurance company actually does with it. And Amala Swinta, a very big thanks also to you at this stage for actually, first of all, providing your feedback to our working group on a regular basis, which is very valuable. And secondly, for finding the time actually to have this presentation with us. So thank you very much, and I hand over to you.
Yeah, glad to. Thank you. Yeah, and thank you for providing or giving the opportunity to present our perspective as an insurance investor on these regulatory ESG requirements. I will go specifically into also why the data from asset managers and GPs are, of course, important for our reportings. So in the beginning, I will talk a bit about why ESG reporting and specifically also the taxonomy reporting is relevant for insurance investors. I will then go a little bit into the data that we use for these reportings, and at the end go also into some factors that are relevant for an effective data exchange from our perspective. So yeah, to start with, why is specifically the Article 8 taxonomy reporting so important for insurance investors? So companies that fall under the relevant sustainability reporting requirements have to disclose the taxonomy eligibility and alignment of their activities and assets under Article 8 taxonomy regulation. So the data that we receive from the companies, funds, and assets that we are invested in the end basically feed into these external reportings. So the taxonomy disclosures are part of the sustainability statement, and this is a section in the annual report. And importantly, the sustainability statement is subject to external assurance. So this means that if we have incomplete or incorrect data, this might lead to auditor findings with corrective measures, and it can also be relevant from a supervisory or reputational perspective. So on the next slide, we see the different data sources that we use for these reportings. For example, for public liquid assets, commercial data providers are important for us because they provide company data, ESG data, such as taxonomy and greenhouse gas emissions. In some cases, we also use publicly available information, such as company annual reports and sustainability reports, where we do our own research regarding these. The Findatex ET is, of course, also an important source for us. And it's great because it's standardized. It's a standardized form of ESG data exchange. We use it primarily for SFDR reporting. As was already mentioned, unfortunately, the ET does not provide all the information or data that we need for taxonomy and CSRD reportings. Last but not least, for private and illiquid assets, we have the challenge that the coverage is like in public available information is not as good as for listed assets. So in this case, asset managers and GPs, of course, become a very important data source. And the data exchange in this case, it can be voluntary or it can also be based on contractual agreements, such as specified inside letters. So if we focus specifically on the next slide on this data delivery from asset managers and GPs, we have a practical challenge in this case. Of course, asset managers do not want to fill in like a different questionnaire for every insurance investor. And of course, the insurance investors don't want to receive the data from asset managers and GPs in widely different formats. So these reportings that we have to do, they already cost a lot of resources. So we try to automate as much of the process as possible. And automation is, of course, much easier if we always receive the data in a specific standardized format. So this is where, for us, the BAI ESG template fills an important gap, because it allows the data exchange in a standardized format, and it gives us all the data points that we need to do our taxonomy and CSRD reporting. So on the next slide, I will talk a little bit more about why not standardization is important for us, but also other factors, such as that the data are timely, that they are reliable and complete. So why are these factors important for us as insurance investors? Specifically for private and illiquid assets, they might represent a significant share of investments. So if we don't receive data for these assets, then this might affect the KPIs that we calculate and report in the end. So DP data strengthen taxonomy and CSRD reportings, and of course they also support audit evidence. There are also some regulatory expectations that matter. So for example, ESRS requires a reasonable effort to obtain value chain data, and reliable data may also support product commitments in some cases. Beyond these regulatory factors, there's also a strategic relevance. So ESG data provided might be important for portfolio steering. We can use ESG data to calculate regulatory KPIs and do an investment analysis. And they are also important for baseline and progress tracking. So for example, for greenhouse gas emissions, if we want to set specific targets regarding, for example, greenhouse gas reductions, we need to define a baseline, and we need to be able to track our progress against these targets. And it is very important for us that we have a somewhat consistent base of data to do this with. So yeah, that brings us to the last point, comparability, which is also relevant in this case. So if different asset managers use different definitions or methodologies to calculate the data, then it of course becomes very difficult to compare different assets and for us to do a meaningful portfolio analysis. So that's why beyond a standardized ESG data delivery, these other aspects such as a reliable data delivery is very important for us for also, for example, ongoing monitoring for progress, tracking progress towards targets. In the next slide, I will go a little bit more into the aspect of timeliness. So we have a data delivery deadline for CSRD and taxonomy, which is the 31st of January. And for SFDR, it is the 31st of May. And of course, in some cases, for some funds, we have SOF is acquiring and aggregating the data for us as a service provider. And in this case, of course, their deadlines are for data delivery are prior to ours. And once we receive the data, either from the asset managers directly or from SOF, the real work actually begins on our side. So most of the work process after these data delivery deadlines, because we then have to do various checks and validations. So basically, we check the quality, the completeness, and the plausibility of the data that we have received. And in case, for example, when we notice that the data is not complete or maybe seems implausible, we have to do some feedback loops with GPs. And after that, we also have to, of course, calculate the KPIs that we have to report. We have to validate our own results, sometimes do error corrections in that part. And last but not least, we have to also prepare all the documentation for the auditor that they require. And as we can see here, we have a very short time span to do all these tasks, so approximately 2 weeks usually. That's also why we start very early with the whole process. So 3 to 4 months prior to the data delivery deadline, we usually do each GP outreach. So we request the ESG data, We communicate template updates, reporting requirements, and of course the data delivery deadline. And this, of course, also enables theoretically an early data submission, which we really appreciate if that's possible, because it enables us to already start the data quality checks early. And basically the task that we have as an insurance investor regarding these reporting requirements distribute much better of the time that we have available to do these tasks. Yeah, and as was already mentioned, we of course also acknowledge that sometimes the data might not be available at the point of the data delivery deadline. And in that case, we also really appreciate if at least the latest available data can be used for the data delivery. So yeah, early data delivery allows us to do checks much earlier and do these feedback loops with GPs. Last but not least, I also want to talk a little bit about why accurate data delivery is also important for us. So for a reliable regulatory reporting, two factors regarding private and illiquid assets are important for us. First of all, it's the quality of the data delivery from GPs. And also it is the controls that we have. So if we start at the beginning, the data delivery from GPs, this can be greenhouse gas emissions, BAI data, or for example, taxonomy data. And as I already mentioned, we afterwards have to do some checks regarding completeness, correctness, and plausibility. So for the auditor, it's important that we can provide enough evidence for the information that we report in the end. And this can, for example, be if there's already independent assurance of the data provided. This can be some sort of evidence. And if that's not available, then of course the controls that we have on the investor side become even more important. From a supervisory perspective, reliable data and also effective controls are important to reduce risk of misstatements and also greenwashing in the end. So there are three takeaways from the insurance investor's perspective, in this case, from these slides. First of all, the data from GPs are very important for us. Also, we really appreciate a standardized data exchange because it makes the whole process quite a lot easier on our side. And we also, of course, appreciate these other factors that are relevant for us, so that the data exchange is timely, complete, and of course, accurate. So to conclude, reliable GP data and effective investor controls on our side enable reliable regulatory reporting for us. And with that, thank you for your attention, and I will get back to Joseph Allen.
Lasvinda, thanks very much. That was very insightful and interesting. I learned a lot, and I think on one of the slides you mentioned that you do not obviously use the data only for fulfilling the regulatory requirements, which is I think obvious, but also for other, let's say, internal purposes, including, I believe you mentioned risk management, portfolio management, strategic asset allocation or something, right? So may I ask maybe briefly here quickly, so which data do you use for which of those, let's say, non-regulatory internal purposes? Is it GHG emissions? Is it taxonomy? Is it, I don't know, PAIs, or what is it? What is the data you use outside of, let's say, taxonomy and CSRD and SFDR?
Yeah. So primarily the main focus at this moment is data. So for emissions, to track changes for these KPIs. But there we also have noticed the challenge that the data are actually quite variable at the moment. So we still see quite huge changes from year to year regarding, for example, GHG emissions. And this is, of course, a challenge if you want to establish a valid baseline for setting targets, etc. But mainly GHG emissions are the focus at the moment.
Got it. So basically you set GHG emissions as a portfolio management target, and then you track the target based on the data received and engage with GPs or investments if something is not aligned, right?
Yeah.
Yeah. Okay. Great. Thank you very much. So I'm sure, dear ladies and gentlemen, you enjoyed it as much as I did. And now the next question is, now that we've just heard what exactly an LP need, the question is how can we actually give it to the LP as a GP? And the answer is obviously the BAI ESG template in that case. And with that, I hand over to you, Joe, to present the changes this year.
Thanks, Igor. Good morning, everybody. Thanks for joining us today. So exactly, let's see how this all comes out in practice. So maybe a bit of background here just on how we came to this template and how we came to the updates. So the idea is, of course, that we have a bit of a working group which brings in a couple of views on all the aspects from market participants. We've got here LPs taking on feedback from their auditors, other ESG and consultants. So the focus here is to understand that, as always with these regulatory topics, interpretation and use cases is differing across participants. So the template really is that kind of general consensus and kind of market kind of the practical average that we need to meet all of those requirements. So that's the benefit of having all of these different opinions and feedback coming in. So that's what brought us here. Back, I'm not sure where the slides have gone, but let's see.
Sorry for a little technical interruption. I think the presentation got stuck, and I'm sure that Michael, maybe the BAI, because I don't see Michael and Florian, maybe BAI disappeared. So we'll go back to it in a second, but maybe in the organizers experienced technical difficulties and will rejoin soon. So maybe in the meantime, also, Joe, to build on what you've just said, the idea for this BAI template originally was actually didn't come from BAI, because at BAI we always thought that we can actually use the the EET that was already available at this point for all kinds of requirements, but it came more from CSRD investors who said we actually need different data points and at a different time. And after we realized that it was not possible to basically implement those frameworks into the EET, the only option was actually to create this template. So that was really driven by the LP initiative. And the good thing about it is that LPs were the ones who provided their feedback. So every single data point there comes from the specific LP requirements rather than from some theoretical, let's say, ideas. So that is how the BAI template was created and have been used across hundreds of GPs over the last years. So now I finished with everything I could say to close the gap. Now let's see quickly what is going on with our, colleagues here. Maybe they have some IT issues, I don't know. And since that is the case right now, I suggest we just swap maybe our agenda and we just do the fireside chat now, because now we're on the cameras, and we just do it now, and then Joe we do the template presentation once Michael and Florian hopefully rejoins. So with that in mind, we've just heard about, let's say, the regulatory requirement. We've heard about the LP perspective from Amalas Winter, who works for LH Group. We started hearing about the BAI template, which is still a bit of a mystery because we don't have the slides, but you can imagine it's an Excel template with different data points there that need to be provided. And since this is the situation, let's say, Marius, I would like to validate it with you, because you obviously also work for a large LP similar but different to the LH Group, Armenia Gota. And the question is there, how do you, what is your reaction to what you've just heard, basically? So how does it look and feel to you, and how is it different maybe for you?
Well, I think Amalas Winter has mentioned most of the points that I would also mention for our side, but maybe just in case of the timeline, because as you already mentioned, those may differ from LP to LP. In our case, they are moved a bit earlier in the year in both cases, and they're both a little bit shorter. I see that someone's rejoining. Michael's back.
No problem. We continue, Michael. We continue here with our fireside chat, and then we swap. Yeah. So it's even better like this without the presentation because we can see ourselves actually. So great.
Yeah. So in both cases, so SFDR reporting and taxonomy and CSRD reporting, our timelines and deadlines start a little bit earlier. So or start pretty much at a similar time, but they actually end a bit earlier. For CSRD, our deadline is actually mostly end of December. So we are aware that we will not receive data for year end, but rather maybe Q3 or even prior year data, whatever's available. As you said earlier on, we appreciate data being available over not having the most recent data. So the reason why we have this shorter timeline is, on the one side, internal deadlines that we have to fulfill for the annual reporting, but also, as Amalas Winter said, 2 weeks is a bit of a short time to do all of the validation checks, quantify, doing the loops with the GPs and correcting data if anything is wrong. So that's why we've decided to have a shorter delivery period, but then have more time to get back to GPs in case of any uncertainties, misunderstandings, and those cases, so that we do not end up with data that we are not able to use because of not being able to answer certain questions. So that's why we've decided to have this shorter delivery period, but a longer validation and looping process. But generally, it's still pretty similar. So from what we are doing, it's similar to what Amalas Winter said. So it's pretty similar to that. But maybe also getting back to what you asked, Diego, in regards to relevance outside of reporting, I think that's something that I would like to emphasize, that it's becoming more relevant to get data outside of reporting. Even the data that we get via the templates, so Amalas Winter already mentioned GHG emissions. I think those are becoming more and more relevant for private assets, not only in our case, but also for other asset owners, with more asset owners setting transition plans, decarbonization targets, or in our case, net zero targets, where you at some point in time have to incorporate private assets, because you cannot just have a target only covering liquid assets. As Amalas Winter said, alternatives may make up a large part of your assets. So that's something where reliable and available data for alternatives is becoming more relevant and pretty much essential for us, even so much that we wouldn't be able to invest in funds where we know that data will not be available, because in those cases you're just not able to follow your decarbonization targets, track the performance. So for us, it's really important to get GHG emissions, but also taxonomy data is relevant outside of taxonomy reporting, especially alignment figures, because they may be relevant for sustainable investment quotas that you report and calculate. And for SFDR, it's also the case that certain pies, not all of the pies, that's quite a lot, but certain selected pies may also be used in portfolio steering and tracking and just overall measurements across the portfolio, also for private assets. So just like to emphasize that it's not only regulatory reporting requirements, but also a lot of strategic and relevant information for us generally.
Marius, thank you for the insight, and maybe to build on this. So if I understand it correctly, you also use the BAI template. The timeline is a bit different from Amalasunta's one, so a bit earlier based on your internal process. Data which can be delivered, let's say, as of the valuation date timely, can be, let's say, replaced by a previous, so latest available data, so that you can fulfill your requirement. And you don't just use it for rec reporting, but also for internal purposes. And where you use it for internal purposes, not just GHG emissions, which is clear, same as for LH group with targets and monitoring and engagement, but it's also some PAIs you said you use, and taxonomy ratios. In terms of taxonomy ratio, just from my understanding, so what exactly is it? What you do with taxonomy ratios internally? Is it more for marketing of taxonomy products, or do you set targets, or what exactly is it? How does it flow into your internal process?
So it's actually more. It's mainly taxonomy alignment. So something that's quite specific. But if we're looking at taxonomy alignment, it's pretty much or a very strict definition of sustainable investments as it's intended to be. And that's why it's also incorporated in internal definitions. If we're looking at SFDR definition of sustainable investments, that's where we also look at taxonomy aligned investments. So it's both for other reportings. In the case of SFDR, that we have quotas that we have to fulfill for our life insurance products, where we would then also have it as, you could say, as a marketing aspect. If you have a quota, then it's more of a marketing aspect or a promise to the insured people. So it's both cases. It's internal monitoring, it's sustainable investment tracking, which may be marketing, and also targets that we set out.
Understood. Thank you very much. So as you can see, dear everyone, we have basically a bit of different but still similar approaches from LPs, from different LPs. So the specific LP requirement is important, although the BAI template can actually fulfill at least the content within the template should be the same across different LPs, which is the benefit of a standardization. And with that in mind, Joe, maybe I move on to you. Sorry, your show got stolen here by the Wi-Fi provider in Bonn. This is no problem. We'll get back to it. But since we're already in the flow, quick question to you. Will it really be much simpler this year on the service provider side, where you collect and aggregate BAI templates this year? Because it was sold as simplification. So will it be really simple now for GPs to provide everything compared to the last year, or do you foresee any challenges? What do you think?
So I think in terms of the simplification, really it comes across, it's a whole new change, and it requires a whole new a rescoping of our methodology and how we create those reports. We have to think of the new consistencies and checks that we look for and validate, and how we validate reports, and how we validate coming in from our from clients and from GPs. So while the simplification is a simplification in terms of maybe a reduction in data points and what they are, given it's a refresh in the sense of how we're defining those KPIs and what contributes to them in numerators and denominators, it does essentially come to as a whole refresh. And then as part of that package, we want to be able to communicate and educate GPs as well, so that communication and maybe calls and kind of the impact in terms of educating our clients, it also reaches out to that. So with these things, I think a simplification is yes, it's sometimes it's the case, but really it's a refresh in terms of everything has to kind of be thought through in terms of the whole cycle, and we can't just kind of think back to last year and add in another section. There's a whole new kind of reapproach to it, which it's an exciting challenge, but it's kind of, you've got to respect the change in that sense, and rather than just kind of take it lightly with a pinch of salt.
So it's basically a new template, one could say, right?
Yeah, I would say so. I suppose, I mean, we'll see later. There's some for the whole template itself that things are common in areas, but the core kind of taxonomy reporting is a whole new template.
Understood. Exactly. So CSRD hasn't changed, but taxonomy actually is a whole new template. Okay. Thank you very much, Joe. And so since it seems that the simplification brought also extra, let's say, work a little bit on this end, my question to you, maybe Amalasunta, do you foresee any further CSRD taxonomy developments, let's say, for the next year, or well, the next year will be the first year we will stop our tradition with BAI webinars on this topic and maybe focus on something else. What do you think?
Yeah, that would be nice. But yeah, no, unfortunately, I don't think that will be the case. So, for example, for taxonomy, from what I know, further simplifications are actually planned. No, I'm not quite sure what they will entail yet. I mean, simplification is, of course, would be good for the simplification, but so yeah, I'm expecting actually that we do need to have a new update next year on what these simplifications will be and how that will affect data exchange and the template requirements.
Understood. So we can ask Michael to book a slot for the next year already, to look for a slot for 2027. Marius, do you agree with this, or what's your view on this? Will we have a bit of rest next year and can do the same as this year?
I think with the current workings in the EU regulatory body, it's quite hard to predict what we will be seeing and when we will be seeing it, because I think that's also the main point, that even if further simplifications are bound to come, such as with SFDR, we don't really know when something will be released, when it will go through the regulatory processes. So it may be the case that we get 1 year of a break, and then in the next year we will have to introduce the simplifications, but it could also be that something might be coming up shortly.
I see. So unpredictability. Even the word simplification is not so simple to pronounce, right?
Yeah.
I just realized a bit of a tongue breaker. So in the interest of time, because we still want Joe to show a couple of slides, maybe one last question on SFDR, because obviously another big change, which is also marketed a bit as simplification, is coming at some point. To our dear LPs here, the question is, PAI statements, right? There is this whole discussion of PAI not needed on the Article 4 SFDR entity level anymore, maybe even next year already. So will it mean for you will not need PAIs anymore, because that's a bit of the hope of maybe some GPs, or how do you see this? Because you also mentioned you use it for internal purposes, from what I understood. So that would be interesting to hear. Amalasuntha, what do you think?
Yeah, I think also very difficult to make a prediction regarding when this will apply. I think data deliveries will still be relevant for SFDR, of course. The specific data points that might be needed might change, but I don't expect there to be no need for data in this regard. I think we'll just have to see what specific data points will be needed in the future. Yeah.
Okay, but you expect to get some data will be needed still from the PAI, whatever data it is, but GHG emissions, probably some other KPIs, right?
Yeah, I definitely expect some data to be needed, yeah.
Marius, how's it for you? So no PAI statement, no ET, or what will it mean?
Well, first of all, it's, as Amalasuntha said, we will have to wait when something applies, whether we get to stop the clock or whether we don't, and then also what the new product level disclosure will look like, because that's the reason why many of the requirements may still be there, even if entity level reporting is not necessary. We still have, in a lot of cases, product level disclosure where we will still have to disclose certain pies. We don't know whether they will be the same ones that we currently have or completely new ones. I wouldn't expect them to be completely different, but maybe they figure out some new KPIs that they want to introduce. But I think besides that, also for us, they will not be completely irrelevant. So as I said, selected pies may be more relevant, so certain ones may not be necessary anymore, but I think some central KPIs will still be required nonetheless.
And with that in mind, I think also an outreach to all of you here, dear participants, if there are some PIs or other data you think they're relevant that should be also included in the future regulation, please do send them to Michael Bommer here from BAI, because we have to do a lot of lobby work and participate in consultation proposals or consultation processes and so on, and can obviously address those topics as well, so that you kind of don't lose data that you may need in the future, right, in the future regime. So right, so I think thank you very much, Marius Amaras Winter. That was very helpful. Maybe quick to end this. I go, Joe, maybe briefly to your slides. Maybe we just focus on the relevant ones in the interest of time. Let me just try to do here 1 second.
They've been built up with a lot of attention. Everyone's excited for this.
Yes, exactly. We built up a lot of tension, but it was not on purpose, I must say. That was more of a 1 second. I'm just clicking through here. 1 second. The tension is building up, dear colleagues. Almost there. Wow, we covered a lot of material here. A lot of content. Okay, Joe, now is the time to shine. So I think this is the...
Yeah, we can get to the next one. So exactly, so this is where we reached off. So where can we find the template, and where can you kind of start your approach to filling out? So we've got a link there at the top, which is to the direct download link, and then also I've just put here, we've got kind of the different sections through the website you can do to reach there, to reach the version 3 there. The previous versions are there for reference, but really kind of consider those as a reference point, but not really anything to consider for this year's reporting. It's version 3.0, and those have been retired. Also here we have some previous the previous discussions that we've had on webinars. These are useful, I think, in terms of, again, if it's not your first time, if it is your first time kind of looking at this template, while the new template and the new criteria in terms of taxonomy DA reporting is what we're covering here, these I think can be helpful in terms of understanding the context behind where the regulation came from, and then also how to build up and can kind of the approach to aggregating and calculating the KPIs within the templates. So yeah, there for your references as a useful thing to go back to. Okay, so what is the changes? What are the changes to the template? So I think the key thing here, as we've kind of mentioned, is that 3.0 is a redesign, and it has to be considered as a redesign rather than version 2.0 with some new fields. So do think of it as a fresh template. So what's happened in the template? So we've gone from multiple sheets from previous versions. We're now into one sheet, which captures all data points across all sections. The IDs have been updated, so there even may be some fields which are actually common in terms of how they're defined for even things like the fund identifier and the ESRS disclosures. However, it's a new template, and then we've kind of refreshed those IDs, and so you can clearly see that the IDs also kind of align to different sections. So the IDs are different, so that it's all been refreshed. The big kind of key change is Annex 10 update. So the taxonomy DA section reflects that new template and reflects what's needed and how it links to the actual regulatory template. So that's kind of the core essence of what we'll maybe look through in a second. And obviously the nice simplification side to it, I guess, for this template is the removal of the Annex 10, the Annex 12 template section, which is a nice welcome reduction in number of fields. So we can go on to the next slide now. And we can see, so which fields will be needed given your potential, the potential LP requirements. So I think we've got there LP1, so doesn't require the CSRD or ESRS disclosures nor taxonomy. Then potentially it's not needed. But given we're all here today, I think this is the least exciting kind of scenario to cover. And so what we can kind of consider is either 2 or 3. So let's say we have an example where the ULP is required to disclose CSRD and ESRS, but they've opted out of taxonomy. Well, in this case, then only those CSRD, ESRS fields would be needed. in, I think, the base case, especially for our panelists here now and who we're reaching out to, we're looking at really typically scenario 3, which is all sections required and all sections. I think in the base case, in general guidance, is really as if you're not sure, then completing the whole template means you're covered on all bases. So that's a typical approach. So now we have here the fields themselves and some simplified examples. And so we can see how what Diego touched on earlier kind of comes into practice in the template. So on the left, you can see the actual IDs and the field itself, and then 3 examples. So the main section here is the kind of first core section, which is the covered asset breakdown. So we've got an example of what we might see from the infrastructure fund, a real estate fund, and then private equity or private debt fund. The first kind of field to focus on here is field 100. This is where we're showing that total covered assets in percentage of total assets under management. So you can see for infrastructure and real estate, that portion is very high, around 90%. We're considering the core kind of makeup of the assets are those covered assets, and we'll see where they fit in below. And for a private equity, private debt fund, really only 10% here. You can see for these cases for infrastructure and real estate that residual kind of 1%, or sorry, 10% there is coming from those bank deposits, derivatives, which are not considered as covered. Then we can see from field 101 onwards, as a kind of the dramatic lightning bolts show here, that everything is in percentage of covered assets now. So we can see that really that breakdown should sum up to 1 to show that's full breakdown of how those covered assets are distributed. For the infrastructure fund, we can see that, as mentioned earlier, these would fall into the field for exposures included under voluntary basis. For the real estate fund, in the other counterparties real estate category. And this example here is showing for the private equity private debt fund, one whereby maybe a small portion is within a company which is in scope of CSRD. So that you can see that's kind of how we see it would typically fill out for these breakdowns. Then we can move on to the next slide, which is when we're going to start to look at the actual eligibility and alignment fields. So as a repeat with previous years and as we saw in the template, these figures can be reported in both a revenues basis and a capex basis. And so the template is a nice kind of duplication. You see the same fields, one in basis of revenues and one in basis of capex, which is kind of what we've shown here with the 2 field IDs, so 200 and 300. They align to the same point, just one's at 200, one's at 300. So we can see at the top here that we're showing eligibility at first, and we're showing that as of all of those covered assets for real estate and infra, typically maybe an example is that all of them would be considered as eligible. And then we see that the alignment is that subgroup and that further criteria to reach, in which case we're seeing a bit of a subset because not all those which are eligible are aligned. Maybe a comment here to mention that top taxonomy eligible field here, that captures everything that is eligible and aligned and everything that is eligible and not aligned. There's previously a breakdown between those, but really that's the total eligibility across all cases in terms of your alignment. So that's the top level figure. And you can see again here, the alignment then is distributed and shown in terms of the breakdown from those different covered assets and what the different categories. So taxonomy alignment in terms of those exposures on a voluntary basis and those in terms of real estate. And then also the example for CSRD. And then finally, so from the ESRS section onwards, the fields are actually rather similar and in most cases defined in the same sense. The key thing to highlight here is we have had a change in terms of the data quality field for those GHG emissions. So previously this field, which is the example here in field 404, this was defined as a binary 1 or 0, which was whether the data quality met a certain threshold. Now this field is a weighted average of the PCAF data quality. So for each of those contributing coverage that reports that 0.2, that 20% coverage would be aligned and be assigned with a data quality, and that is going to all contribute to a weighted average that is put into 404. So you can see how in this example we have 1.2 rather than 1 or 0, and that's a weighted average. Everything else actually in ESRS is actually kind of remains the same as previous years, just with the new IDs. So we've not kind of touched on it here, but it all looks rather similar from there onwards. And then I think that's essentially us in terms of the template and the practical filling out. Thanks.
Yes, Joe, thank you very much for finishing despite our original plan on time and despite the interruptions. So thanks a lot for this. Also, Marius and Malacinta, thank you so much for providing insights. I'm sure it will be very helpful for the GPs to prepare the reports this year. And Michael, I think that was us really, so over to you.
Well, thank you very much, and sorry again for the technical problems during the webinar. So thank you, Amalas Winter and Marius, having developed with us this actual version of the BAI ESG template and having presented it also to our audience. And thank you, Joseph and Jegor, also for your insights and descriptions and regulatory requirements. So stay tuned with BAI, stay tuned with our future webinars and other events, and happy to see you again within the next weeks and months. Bye-bye. Have a nice day.
Bye. Thank you.